I wouldn't ordinarily record a video on a Monday evening, but the data I'm looking at right now simply can't wait until Tuesday. Something is being set up ahead of tonight's market open. The pieces are shifting. The formation is taking shape. And if you're sitting on silver positions without grasping what could unfold in the next 12 hours, you might wake up Monday morning to an entirely different market. I'm observing unusual activity in Asian order books, abnormal options positioning set to expire this week, COMEX delivery mechanics entering a critical stage, and most troublingly, the same margin requirement patterns that came before the February 12th crash. This isn't speculation. This is pattern recognition from someone who has watched these setups materialize before. Before we break this down, clear as always, I will never ask you for money. No paid groups, no courses, no signal services. If anyone uses my name to sell you something, it's a fraud. I produce these videos because preparation outperforms reaction. This is education, not financial advice. Your money, your choices. Verify everything I present. Links are in the description. Leave a comment if you're watching live. Let me know you're ready for whatever Monday delivers. What I'm observing right now, it's 4:20 p.m. Eastern on Monday afternoon as I record this. American markets are closed. Everything looks calm on the surface. Most retail traders are watching football, enjoying time with family, not giving the silver market a second thought. But global markets never truly rest. And what's being positioned right now suggests Monday could be explosive, in either direction. Let me walk you through what I'm tracking. First signal. The Shanghai premium widened on Friday to $10.15 above Western spot. That's the largest gap since China's export restrictions went into effect on January 1st. Asian buyers are paying a 13% premium for physical metal. That kind of premium doesn't materialize without cause. Industrial consumers are bidding aggressively because they're worried about supply availability. Second signal. The CME Group issued an unusual number of position limit notices on Friday afternoon. Whenever exchanges begin publicly monitoring position concentrations, something is developing. They're watching the large traders, and large traders are preparing for something. Third signal, options open interest on the February expiration reveals a massive clustering at the $80 and $85 strike prices. That expiration arrives this week. Market makers need to hedge that exposure, and the hedging process generates mechanical price movements. Fourth signal, COMEX registered inventory remains at 98 million ounces. The March delivery window opens in 12 days. Open interest still exceeds 400 million ounces. The math hasn't improved. If anything, it's deteriorated since the February 12th crash. When multiple signals converge at the same time, heightened attention is warranted. Tonight is one of those moments. Let me explain why Monday night represents the most hazardous window in the weekly trading cycle. Because most retail traders don't understand the mechanics. CME Globex futures reopen at 6 p.m. Eastern on Monday. That's less than 2 hours from now as I record this. But global positioning began hours ago. Singapore opened first, then Hong Kong, then Shanghai futures trading. By the time CME reopens, Asian markets have already established a direction. American traders are responding to moves that already occurred. On Monday evenings, liquidity is at its thinnest point of the entire week. Market makers scale back activity. Algorithms pull away. Order books are thin. Large orders that would barely register during normal trading hours can produce dramatic price swings on Monday evening. This generates gap risk. Price doesn't transition smoothly. It leaps. You go to bed with silver at $77, you wake up with silver at $72 or $85. No chance to react. The move already happened. The February 12th crash was executed on Thursday morning, but the groundwork was laid during Monday evening, February 9th, through Monday. They tested liquidity. They gauged order book depth. They identified where stop losses were concentrated. Then they struck on Thursday when retail was most exposed. If something is being planned for Monday, tonight is when the final positioning occurs. The calm before the disruption. Here's what worries me the most. The pattern that preceded the February 12th crash. On February 10th, Tuesday, at 5:15 p.m. Eastern, after regular trading hours, the CME Group announced a margin requirement increase from 18% to higher, effective immediately. Retail traders only discovered the change Wednesday morning, already in violation, already facing margin calls. The crash intensified because retail was simultaneously covering margin calls and confronting coordinated selling. What's the current status? As of Friday's close, no new margin notices have been published, but the CME Group can issue notices at any time, weekends included. They could publish a margin increase at 8 p.m. tonight, effective Monday morning. The exact same approach as before. I'm not claiming they will. I'm pointing out they can. And history demonstrates they act precisely when it inflicts maximum harm on retail long positions. If you're carrying leveraged silver positions over the weekend, you're vulnerable to overnight rule changes. You can't respond until markets open. By that point, you may already be in margin violation. Check the CME Group's advisory notice page before going to bed tonight. Check again the moment you wake up. If margin requirements changed overnight, you need to know immediately. not after your morning routine, immediately. Let me describe what I'm seeing in Asian markets that has captured my attention. Normally, Monday evening, Asian trading is subdued. Consolidation from Friday's close, minimal directional conviction, traders waiting for Monday's cues. But Friday's Asian session displayed unusual intensity. Large buy orders hitting Singapore silver futures, abnormal volume in Hong Kong gold and silver contracts, and the Shanghai premium expanding rather than narrowing. This indicates Asian institutional buyers are preparing for something. They're not waiting for Monday, they're acting now. Two possibilities exist. In the bullish scenario, Asian buyers recognize the supply constraint reality. COMEX inventory at historic lows, Chinese export restrictions, tightening physical availability. They're front-running Monday's American session because they expect Western prices to converge upward with Eastern premiums. In the bearish scenario, Asian institutions have received information that American markets haven't yet. Regulatory changes, exchange interventions, something that favors short positions. They're positioning ahead of an announcement. I don't know which scenario is accurate. Both are consistent with the data. But the abnormal activity itself is the signal. Something is in motion. Tonight will reveal the direction. This week brings the February options expiration on COMEX silver futures. Most retail traders don't monitor options expiration dates. They should, because expiration generates mechanical price movements. Here's the current options landscape for the February expiration. There's massive call open interest at the $80 strike, thousands of contracts. If silver approaches $80, market makers who sold those calls must purchase futures to hedge, creating buying pressure that can push price through $80. Significant call open interest also sits at the $85 strike. If silver breaks above $80, those $85 calls come into play, requiring additional hedging, generating more buying pressure with potential for a gamma squeeze toward $85. On the downside, put open interest is concentrated at the $75 and $70 strikes. These puts provide support below current prices. Market makers hedging those puts create selling pressure above these levels. But if price remains above $70, the puts expire worthless, no further hedging is needed, and selling pressure evaporates. The battlefield is $77 to $85 this week. Expiration arrives Friday. Each day drives price toward resolution. Monday establishes the tone. Here's where the manipulation opportunity lies. If large traders want the calls to expire worthless, they need the price below $80 through Friday. They might engineer downward pressure early in the week. If they want the puts to expire worthless, they need the price above $75. They might prop up prices at current levels. The options market creates price targets that wouldn't exist based on fundamentals alone. Recognizing these targets helps you interpret potential Monday action. The March delivery window opens February 27th, 12 days away. First notice day is when futures holders formally declare their intention to take physical delivery. Current situation, open interest on March. Contract exceeds 400 million ounces in paper claims. Registered silver at the COMEX stands at 98 million ounces. The coverage ratio is 4-to-1, 4 paper claims for every physical ounce. This math generates pressure. Large traders intending to stand for delivery are positioning now. They're not waiting until February 26th. They're ensuring their positions are secured before first notice day. If sophisticated money believes March delivery will encounter problems, they're accumulating this week. That accumulation produces buying pressure. If sophisticated money believes the COMEX will navigate March delivery through cash settlements and rule modifications, they may not stand for delivery, reducing the pressure. The next 12 days will reveal which scenario materializes, but the positioning is happening now, this week, beginning tonight. Monitor open interest changes on March contracts. If open interest drops substantially, longs are rolling forward to later months. Pressure decreases. If open interest remains steady or grows, longs are holding firm, pressure builds. Monday's trading provides the first indication of March delivery intentions. The February 12th crash enabled banks to cover concentrated short positions at $77 instead of $121. That was the purpose. Mission accomplished for the shorts who needed rescue. But the critical question now, what positions are banks carrying into Monday? In the first scenario, banks covered their shorts and moved to a neutral stance. They captured profits from the crash. They're not positioned directionally. Monday could move either way based on order flow. In the second scenario, banks covered their shorts and went long. They used the crash to reverse from short to long, buying what retail was compelled to sell. Now they want higher prices to profit on long positions. In the third scenario, banks didn't fully cover. Some short positions persist. They need another decline, another margin hike, another crash to complete the covering. Friday's Commitment of Traders report offers some clues. Commercial net positioning decreased during the crash. Shorts were covered. But the report carries a 3-day lag. We don't know precise positioning as of Monday night. If banks have flipped long, Monday should display strength. Rallies permitted to continue. No immediate suppression attempts, price discovery trending higher. If banks still maintain shorts, Monday may show persistent pressure. Rally attempts capped, selling into strength, potential for another engineered decline. Watch the tape Monday morning. The price action reveals positioning that reports cannot capture in real time. The CME announcement risk. The CME Group can announce rule changes at any point, including Monday night, including Monday pre-market. This is the wild card that generates overnight risk. What types of announcements? Margin requirement increases, the same tool deployed on February 10th, potentially reusable. Position limit changes. The exchange can lower maximum positions held by individual traders, forcing large longs to liquidate and generating selling pressure. Delivery rule modifications. The exchange can alter March delivery terms, extend delivery windows, or introduce alternative settlement options. All signals that the exchange is managing stress. Trading halts. In extreme circumstances, the exchange can suspend trading entirely. We witnessed this with nickel on the LME, with 8 days of halted trading while shorts negotiated their survival. I'm not forecasting any specific announcement. I'm emphasizing that exchange announcements can arrive without warning and dramatically reshape conditions overnight. Before you sleep tonight, check CME advisory notices. When you wake up, check again right away. Information asymmetry is how they prevail. Staying informed is your only defense. Silver doesn't trade in isolation. Dollar strength or weakness influences all commodity prices. The current dollar index situation, DXY, showed weakness heading into Friday's close, testing support levels. If the dollar breaks lower, commodities typically rally, and silver benefits from dollar weakness. However, the Federal Reserve speaks this week. Multiple Fed officials are scheduled for public commentary. Any hawkish surprise, any suggestion of rate increases, and the dollar could strengthen rapidly, creating resistance for silver. Monday night trading in currency markets provides early clues. If dollar futures are declining as Asian markets open, silver likely finds support. If dollar futures are firming, silver may encounter headwinds. Watch DXY futures when they open tonight. The currency market frequently leads commodity direction. Understanding dollar dynamics helps you decode silver movements. What institutional players are doing. Let me share what I believe sophisticated institutional money is doing this weekend. Not retail, not casual traders, but the institutional participants who drive markets. They're tracking Asian order flow in real time. They have access to market depth data that most retail traders never see. They know where large orders are placed. They know where liquidity exists. They're running scenario models on March delivery, computing probabilities of delivery stress, and positioning accordingly. If they anticipate a squeeze, they're accumulating. If they expect exchange intervention, they're positioning for that intervention. They're monitoring CME advisory pages for any announcement. They have automated alerts configured. They have teams watching overnight. They don't get blindsided by margin increases. They're communicating with one another, not unlawfully, but the large participants understand what other large participants are thinking. They consume the same research. They attend the same events. They share a context that retail lacks. Institutional money isn't lying awake Monday night worrying about Monday. Institutional money is positioned for Monday in either direction, with capital reserves ready to capitalize on volatility. Retail sleeps unaware, wakes up to moves that already occurred, reacts rather than anticipates. Don't be retail tonight. Let me share exactly what I'm doing tonight and Monday morning. Not guidance for you, just transparency about my process. Tonight, before 6 p.m. Eastern, check the Shanghai Premium 1 final time. Any expansion signals Asian urgency. Check CME advisory notices for any margin changes or rule modifications. Review options, open interest for Monday morning reference. Set price alerts at $75, $80, $82s, and $85. Any breach triggers a notification. Tonight at 6:00 p.m. Eastern when Globex opens. Watch the first 15 minutes of trading. Direction and volume reveal immediate sentiment. Check dollar index futures for correlation. Monitor unusual order flow through level 2 data. Note the opening range for Monday reference. Monday morning before market open. Check CME advisories again. Overnight announcements are possible. Review the overnight trading range. Any gap signal, strong directional pressure. Check the commitment of traders report for positioning insights. Review any weekend news that could influence trading. Monday regular session. Watch first hour volume and direction. It sets the day's tone. Monitor whether rallies get sold into or dips get bought. This reveals underlying positioning. Track registered inventory reports when published. Watch for any exchange announcements during the session. This is my process. Every Monday night before potentially significant moves, preparation creates advantage, reaction creates losses. Let me outline the two scenarios I'm watching for Tuesday. Bullish scenario triggers. Tonight's Asian session shows buying pressure. The Shanghai Premium holds or expands. Singapore futures find bids. CME Globex opens with a gap higher above $78. The dollar index displays weakness. No margin requirement increases are announced. The first hour Monday shows follow-through buying with rallies not immediately sold off. Price approaches $80 and the call options strike with momentum. If these triggers align, we could see a move toward $82s, $85 this week. Short covering from trapped positions, a gamma squeeze from options hedging, and building anticipation around March delivery. Bearish scenario triggers. Tonight's Asian session shows selling pressure the Shanghai premium contracts. CME GlobeX opens with a gap lower below $76. The dollar index strengthens on Fed-related concerns. A margin requirement increase is announced Monday evening or Monday pre-market. The first hour Monday shows accelerating selling with rallies immediately capped. Price tests $75 support. If these triggers align, we could see a retest of the $72 to $74 lows. Another liquidation cascade, another shakeout ahead of March delivery. I don't know which scenario will play out. Nobody does until it happens. But knowing the triggers helps you interpret early price action and respond appropriately. Let me speak to those holding physical silver rather than paper positions. You don't need to monitor Monday night trading. You don't need to wake up checking CME advisories. You don't need to concern yourself with margin requirements. Your silver sits in your safe. It's indifferent to the GlobeX Open. It's unaffected by margin increases. It doesn't care about options expiration. The volatility I'm describing only applies to paper positions, futures, options, ETFs, leveraged products. Physical metal exists outside the game. You're not subject to exchange rule changes, not exposed to overnight gaps, not vulnerable to liquidation cascades. If you hold physical, Monday morning is simply another day. Price may be higher, maybe lower. Your ounce count remains the same. Your protection remains the same. This is the core advantage of physical over paper. Paper operates under their rules. Physical operates under yours. Tonight's warning is directed at paper holders. Physical holders can rest easy. Monday, February 16th, 2026. Less than 2 hours until CME GlobeX opens. Asian markets are already positioning. Options expiration approaches. The March delivery window is 12 days away. COMEX inventory sits at historic lows. The Shanghai premium stands at 13% above Western prices. Something is being positioned for Monday. I don't know the direction. I know the pieces are moving. The same patterns that preceded the February 12th crash are present. Margin requirement risk, options concentration, delivery window pressure, thin Monday liquidity. If you're holding paper positions, stay vigilant tonight. Check advisories before bed. Check again immediately upon waking. Set price alerts, have capital available for margin calls. Understand that you're exposed to overnight rule changes. If you're holding physical, rest peacefully. You're outside their game. Either way, Tuesday arrives in 12 hours. The market will reveal what Monday night positioned. I'll be watching. Will you? Verify everything. Trust no one. Protect your capital.